Great flows from the ETFs. BlackRock is showing record numbers. Our companies raised $19 billion this year.
Right.
All of it went into Bitcoin. We just announced $217 million of Bitcoin purchases this morning before I walked onto this set here.
Wait.
$217 million, just slightly less than 2,000 Bitcoin. Our first buy, and we were the first public company to buy Bitcoin, we bought $250 million of Bitcoin, and that was like all the money we'd come up with in 30 years.
Yeah.
And this was just a short week.
As Bitcoin steadies above $112,000, one company is rewriting the playbook on corporate finance, turning digital assets into a cornerstone of balance sheets and a catalyst for market transformation. Michael Saylor, co-founder and executive chairman of MicroStrategy, remains one of the most influential voices in the Bitcoin space as the cryptocurrency trades at $112,527 with a market cap of $2.24 trillion. While prices consolidate, Saylor underscores a powerful shift in market perception. Most equity analysts now see Bitcoin's trajectory above $150,000. He frames this movement not as speculation but as a structural transformation of capital markets, driven by rising education, adoption, and corporate participation. With ETFs like BlackRock recording historic inflows, institutional demand continues to reinforce Bitcoin's role as a core financial asset. MicroStrategy has placed itself at the center of this narrative. The firm recently added nearly 2,000 BTC worth $217 million to its already massive treasury, strengthening its position as the world's largest corporate holder of Bitcoin. For investors, MicroStrategy stock has become a leveraged proxy for Bitcoin, magnifying gains and losses through its recursive strategy of raising capital to buy more BTC. Saylor highlights that traditional investors often remain bound to equity and credit markets, so MicroStrategy offers Bitcoin-backed instruments tailored to varying risk profiles, ranging from conservative exposure to leveraged upside. Central to its evolving strategy is the use of perpetual preferred stocks, such as STRK and STRF, offering 9 to 10% dividends while enabling leverage in the 30 to 40% range beyond what bonds or margin debt typically allow. This innovative structure, according to Saylor, provides flexibility without the same credit risks, ensuring resilience through downturns. Beyond MicroStrategy, more than 180 companies have followed suit, adding Bitcoin to balance sheets in place of sovereign debt or idle cash. While risks tied to rates, liquidity, and asset concentration remain, Saylor's approach highlights a broader trend. Bitcoin is no longer on the fringes, it is becoming the backbone of corporate finance. Let's get back to the interview.
Well, most of the equity analysts that follow our stock have target prices for Bitcoin, and they're all north of 150. Bitcoin represents a digital transformation of the capital markets, and so the more people know about it, the more they get educated on it, the more companies embrace it, the higher it goes. You can't make any more of it. Great flows from the ETFs. BlackRock is showing record numbers. Our companies raised $19 billion this year.
Right.
All of it went into Bitcoin. We just announced $217 million of Bitcoin purchases this morning before I walked onto this set here.
Wait.
$217 million, just slightly less than 2,000 Bitcoin. Our first buy, and we were the first public company to buy Bitcoin, we bought $250 million of Bitcoin, and that was like all the money we'd come up with in 30 years.
Yeah.
And this was just a short week. Well, a lot of investors, they have to buy equity, and so we offer Bitcoin-backed equity, or they need to buy credit, and so we have 4 Bitcoin-backed credit instruments, preferred stocks. So the ones that are risk-averse, that want the exposure, are buying the credit, like Strike, which has got the upside with some downside protection. The ones that are buying the equity want 2x Bitcoin. They want more volatility, they want more performance, and they see it as a more efficient way to get that exposure. Turns out that 99% of the money in the world is mandated to equity and credit. Most of these professional investors and most of these passive funds, they can't buy the underlying commodity even if they wanted. You know, we constructed a pretty bulletproof balance sheet. I would say we have a PhD in leverage by now because we lived through the last crypto winter. We went from 6,000 to 16,000. We were buying Bitcoin at 16,000. We used to use senior debt, and we had some margin type loans. We rolled out of that to converts, and this year we really have started to reallocate to preferreds. And preferreds are the best kind of leverage because they never come due. So I think we're fine right now because substantially our leverage comes from preferred stocks rather than from debt at all. I don't think there's a bias. I don't think we expected to be selected on our first quarter of eligibility. We figure it'll happen at some time. There's a digital transformation in the markets. This is a brand new, novel concept. Every quarter, we make new believers. We get more support from banks, from politicians, from credit rating agencies, et cetera. I think that will continue for the foreseeable future. If you were using margin debt, you'd never want to go beyond 10% leverage. If you were using bonds, maybe 20, 25% is about the most you would want to do. But if you're selling a perpetual instrument, I borrow $1 billion forever, and I agree to pay you, say, 10% dividend yield forever. The principal's never coming due, right? And the preferred stock, by definition, is a dividend. It's not a coupon. The board has to have the option to suspend it in duress. So it's practically speaking possible to take your leverage beyond 20% to 30 or 40% even, but you don't have the kind of credit risk you have when you have a bond or a margin. We've had 180 companies that have adopted Bitcoin on their balance sheet. We were the first. Companies are buying Bitcoin instead of holding sovereign debt, or they're buying Bitcoin instead of dividending out their cash flows, or instead of buying back their stock, they're just buying Bitcoin. And so they're actually increasing their capital base. They're decreasing the credit risk in the company. There are a few companies that are going to issue Bitcoin-backed credit. They may do it with bonds, they may do it with converts, they may do it with preferreds. We're the first company to create liquid preferred stocks that represent Bitcoin-backed credit. Companies like Metaplanet will probably issue preferred stocks. They'll do it in Japan, in a yen basis. Most other companies are just going to creep into this by building up their capital base, and they're not going to get into the business of issuing credit instruments backed by Bitcoin. We have about 11% of our Bitcoin holdings are bonds, so convertible bonds, and like another 9% are preferreds. Okay. So not that much. I mean, really, we have $72 billion of Bitcoin. We have $8 billion of convertible bonds that will eventually equitize. More than half of them are already in the money.
Bitcoin's steady climb toward $112,000 coincides with record highs in traditional equity markets, particularly the Nasdaq, highlighting a new era of interconnected strength between digital assets and conventional finance. Once viewed primarily as a speculative hedge against inflation and monetary debasement, Bitcoin is increasingly functioning as both a defensive asset and a high-growth instrument within global portfolios. Its dual role reflects the broader transformation of capital allocation, where investors are no longer forced to choose between traditional equities and alternative assets but instead seek hybrid exposure that captures the best of both. This shift is being accelerated by the rise of innovative balance sheet strategies. Corporations employing perpetual preferreds and structured credit have pioneered new financing models, blending corporate capital structures with Bitcoin accumulation in ways that extend leverage capacity while reducing immediate repayment obligations. Such mechanisms not only unlock higher exposure to Bitcoin but also demonstrate how digital assets can be woven into the fabric of corporate finance without relying solely on debt markets. At the same time, ETFs and institutional vehicles are funneling billions into Bitcoin with a level of consistency that signals deeper conviction and long-term integration. This institutional demand strengthens Bitcoin's role in the global economy while creating liquidity channels that did not exist even a few years ago. Still, the path forward is not without risk. Heavy concentration in a single, volatile asset introduces vulnerability, while the liquidity of preferred stock markets remains limited compared to traditional financing avenues. Layered on top are macroeconomic uncertainties, interest rate shifts, regulatory changes, and global liquidity cycles that can quickly reshape market dynamics. For investors, Bitcoin and its equity-linked proxies present asymmetric upside potential, yet the key lies in approaching this exposure with discipline. The greatest rewards will flow to those who balance conviction with robust risk management, navigating volatility while positioning for structural growth. What happens when a public company turns Bitcoin into its primary treasury asset and builds an entire financial strategy around it? Crypto is reshaping global finance, but success belongs to investors who stay disciplined and grounded in fundamentals. Stay tuned, like, share, and subscribe for more sharp insights into the future of crypto.